quiet but powerful shift is unfolding beneath the surface of the global financial system, and most people are completely unaware it is happening. While attention remains fixed on stock markets, inflation headlines, political debates, and short-term economic data, a far more consequential story is developing in the bond market, the foundation that quietly supports nearly every aspect of modern finance. At the center of this shift is a change in behavior by one of the United States' most important and reliable financial partners. For decades, Japan has been one of the largest foreign holders of U.S. Treasury debt, playing a critical role in keeping borrowing costs low and reinforcing confidence in the U.S. dollar. Those bonds were seen as safe, predictable, and untouchable, forming a bedrock of global money flows. But that long-standing assumption is now being tested. Japan has begun reducing its holdings of U.S. debt, not dramatically or suddenly, but steadily enough to capture the attention of global markets. This move matters because it signals a change in confidence, strategy, and necessity at a time when the United States is issuing enormous amounts of debt to fund its operations. At the same moment Japan is stepping back, the Federal Reserve is stepping forward. After years of shrinking its balance sheet and pulling liquidity out of the system, the Fed is preparing to buy large quantities of Treasury securities once again. Officially, this is framed as a technical measure designed to maintain market stability and manage liquidity, not as a return to easy money or stimulus. But regardless of how it is described, the reality is simple. When one of the world's largest foreign buyers pulls away, the central bank becomes the buyer of last resort. This is not an ordinary policy adjustment. It is a response to a deeper imbalance forming beneath the surface of global finance. The bond market is often overlooked because it lacks the drama of stock price swings, yet it is far more powerful in shaping economic reality. Interest rates on mortgages, business loans, government borrowing, and consumer credit all trace back to what happens in the Treasury market. When demand for U.S. debt weakens, even slightly, yields rise and higher yields ripple outward through the entire economy. That means higher borrowing costs for governments, businesses, and households alike. It affects hiring decisions, housing affordability, infrastructure spending, and long-term economic growth. This is why Japan's decision carries weight far beyond its borders. Japan is not acting out of hostility or political intent. It is responding to its own domestic pressures, including a massive debt burden, an aging population, and persistent currency challenges. Selling U.S. bonds can help stabilize the yen or free up capital for internal needs. But when a country of Japan's size adjusts its strategy, the consequences are global. The United States relies heavily on consistent demand for its debt to finance spending without triggering sharp increases in interest rates. For decades, foreign buyers provided that demand quietly and reliably. The system worked because trust was deep and participation was broad. What we are seeing now is not a collapse of that trust, but a gradual reassessment of priorities. Markets are extremely sensitive to such reassessments because they force a reevaluation of long-held assumptions. If foreign demand becomes less predictable, the burden of maintaining stability shifts inward, placing greater responsibility on domestic institutions, especially the Federal Reserve. The Fed's involvement reassures markets in the short term, but it also raises important questions about long-term sustainability. How often can a central bank step in before markets become dependent on intervention? How does this affect inflation expectations, asset prices, and confidence in monetary policy? These questions are not theoretical. They shape investor behavior and influence capital flows across borders. What makes this moment especially significant is how quietly it is unfolding. There is no single dramatic announcement, no sudden shock that captures public attention. Instead, there is a slow but meaningful change in behavior by key players in the global system. History shows that such changes often matter more than sudden crises because they reshape expectations. Expectations influence decisions, and decisions determine outcomes. Japan's reduced bond buying and the Fed's response are sending signals that the financial world is adjusting to new realities. These adjustments reflect a more complex and interconnected global economy, where no single player can act without affecting others. For everyday people, this story matters even if it feels distant. Bond market dynamics influence interest rates on homes, the cost of credit, job creation, and long-term financial security. They affect government budgets, public services, and economic opportunity. Why understanding what is happening now provides insight into why money feels tighter, why borrowing costs remain elevated, and why central banks appear more active than ever. This is not just a finance story. It is a story about trust, power, and adaptation in a world where economic relationships are evolving. As we move deeper into this shift, the actions taken today by Japan, the Federal Reserve, and global investors will help define the future structure of global finance. The changes may be gradual, but their impact will be lasting, shaping how money flows, how risk is priced, and how stability is maintained in an increasingly uncertain world. To fully grasp why the current shift carries so much weight, it is essential to understand the unique role U.S. Treasury bonds play in the global financial system and why foreign participation has been so critical for decades. Treasury bonds are not just another investment vehicle competing with stocks or corporate debt. They are the backbone of global finance, the reference point against which risk, safety, and value are measured across markets. When the United States issues Treasury debt, it is not merely borrowing money to fund government operations. It is supplying the world with a trusted financial instrument that underpins banking systems, international trade, reserve management, and monetary policy worldwide. At their core, Treasuries function as formal IOUs issued by the U.S. government. Investors who purchase them are lending money in exchange for a guaranteed return over time. These securities come in various maturities, ranging from short-term bills to long-term bonds that extend decades into the future. The longer the maturity, the greater the interest rate typically offered, compensating investors for time and uncertainty. What separates Treasuries from most other forms of debt is credibility. They are backed by the full faith and credit of the United States, a phrase that reflects the country's historical commitment to honoring its obligations regardless of political shifts, economic downturns, or global crises. This credibility has been reinforced repeatedly, even during periods of extreme stress, such as wars, recessions, and financial meltdowns. Because of this track record, Treasuries are widely regarded as the safest and most liquid asset in the world. Liquidity is especially important. A liquid asset can be bought or sold quickly without causing dramatic price changes. This characteristic makes Treasuries indispensable to financial institutions, which use them as collateral, balance sheet anchors, and risk-free benchmarks. Banks rely on them to meet regulatory requirements. Pension funds depend on them to match long-term obligations. Insurance companies use them to ensure predictable returns. Beyond domestic institutions, foreign governments and central banks rely on Treasuries as a core component of their foreign exchange reserves. Holding U.S. debt allows countries to manage currency stability, facilitate international trade, and maintain confidence during periods of market stress. The dollar's role as the world's primary reserve currency is deeply intertwined with the Treasury market. Because global trade is largely conducted in dollars, countries accumulate dollars through exports and then reinvest those dollars into U.S. debt. This cycle has reinforced demand for Treasuries and supported the dollar's dominance for generations. Japan's role in this system has been particularly important. As an export-driven economy with large trade surpluses, Japan accumulated vast amounts of dollar reserves over time. Investing those reserves in U.S. Treasuries made practical sense. Bonds were safe, liquid, and yielded consistent returns while supporting Japan's currency strategy. By holding large quantities of U.S. debt, Japan helped stabilize global markets and reinforce confidence in the American financial system. In return, the United States benefited from lower borrowing costs and steady foreign demand, allowing it to finance spending at scale without immediate pressure on interest rates. This arrangement became so normalized that markets treated it as permanent. Few questioned whether major holders like Japan would ever meaningfully reduce their exposure. Yet global finance is shaped by necessity, not tradition. Japan's domestic situation has evolved. Its population is aging rapidly, placing strain on public finances. Government debt levels are extremely high. Economic growth has remained modest. At the same time, the Japanese yen has faced persistent weakness, increasing the cost of imports and complicating monetary policy. In this environment, holding large amounts of foreign debt becomes a more complex decision. Selling U.S. Treasuries can provide liquidity, support the yen, and help address domestic financial pressures. These decisions are not driven by ideology or geopolitical intent. They are pragmatic responses to changing conditions. However, when a country of Japan's size adjusts its strategy, the impact is felt far beyond its borders. The U.S. Treasury market operates on balance. Supply must meet demand smoothly to prevent volatility. The United States issues trillions of dollars in debt each year to fund government operations, refinance existing obligations, and cover budget deficits. That system depends on reliable buyers. When a major buyer reduces participation, even gradually, it introduces friction. Bond prices become more sensitive. Yields begin to rise. Volatility increases. These changes matter because Treasury yields influence the entire financial system. They serve as the benchmark for interest rates on mortgages, business loans, and government borrowing worldwide. Higher yields raise borrowing costs, slow investment, and tighten financial conditions. This is why markets watch foreign demand so closely. It is not simply about who owns the debt. It is about whether the system that has supported global finance for decades remains as stable as it once was. Japan's shift forces markets to confront uncomfortable questions. If one of the most reliable holders is stepping back, who replaces that demand? Can domestic investors absorb the difference at current interest rates? Will yields need to rise to attract new buyers? And if so, how will that affect economic growth, inflation, and financial stability? These questions are now central to global market psychology. They explain why the Federal Reserve's actions matter so much in this context. As foreign participation becomes less predictable, the Fed's role grows more prominent. The central bank becomes not just a regulator of monetary conditions, but a stabilizing force ensuring that the world's most important debt market continues to function smoothly. This dynamic marks a subtle but meaningful evolution in global finance. It suggests that long-standing assumptions are being tested and that the balance of responsibility is shifting. Understanding this foundation is critical because it sets the stage for why central bank intervention is increasing and why the bond market is sending signals that cannot be ignored. As foreign demand for U.S. Treasury debt becomes less certain, the focus naturally shifts to the one institution capable of preventing disruption at scale: the Federal Reserve. The Fed is not just another participant in the bond market. It is the central stabilizing force that ensures liquidity, confidence, and functionality across the financial system. For years, the Fed had been moving in the opposite direction, deliberately reducing its bond holdings through a process known as quantitative tightening. This approach was designed to pull excess liquidity out of the system after years of aggressive stimulus, helping to control inflation and normalize monetary policy. That strategy depended on the assumption that private investors and foreign governments would continue to absorb new Treasury issuance without difficulty. When that assumption begins to weaken, the entire framework must adjust. Japan's gradual reduction in Treasury holdings introduces precisely that challenge. Even a measured pullback by a major holder can create gaps in demand when issuance remains massive. In response, the Federal Reserve has begun preparing to increase its presence in the Treasury market, not as a stimulus engine, but as a liquidity manager and buyer of last resort. Officially, these purchases are framed as technical operations designed to keep markets functioning smoothly. In practice, they serve a critical purpose. They ensure there are enough buyers to prevent disorderly price movements and sudden spikes in yields that could destabilize the economy. The Treasury market is not an ordinary market. It underpins the pricing of nearly every other financial asset. If liquidity dries up or confidence falters here, the effects cascade rapidly into equities, corporate credit, housing, and global banking systems. This is why the Fed treats disruptions in the bond market as systemic risks rather than isolated events. By stepping in, the Fed reassures investors that the market will remain liquid, that trades can be executed, and that extreme volatility will be contained. That reassurance alone can prevent panic. Markets often react more to uncertainty than to actual conditions. The Fed's presence reduces uncertainty by signaling readiness and capacity. However, this intervention also carries long-term implications. Each time the central bank steps in to stabilize markets, it reinforces the perception that it will always be there. Over time, this expectation can distort risk-taking behavior. Investors may become more willing to take on leverage or ignore underlying weaknesses, assuming the Fed will intervene if conditions deteriorate. This dynamic creates a form of dependency that can make the system more fragile in the long run. There is also the challenge of credibility. While the Fed insists that these bond purchases are not a return to quantitative easing, the distinction can be difficult to maintain in the eyes of the market. Expanding the balance sheet, even for technical reasons, influences financial conditions, asset prices, and inflation expectations. This places the Fed in a difficult position. It must support market stability without undermining its commitment to controlling inflation. The timing of these actions further complicates matters. Global economic conditions are already strained by high interest rates, slowing growth, geopolitical tensions, and elevated debt levels. In such an environment, even modest disruptions can have outsized effects. The Fed is attempting to strike a delicate balance, providing enough support to maintain order without encouraging excess risk or fueling inflationary pressures. This moment highlights how deeply interconnected global finance has become. The decision made in Tokyo influences policy in Washington. Currency movements, trade balances, and debt markets interact in real time. The Federal Reserve's response to Japan's actions is a clear example of this interconnectedness. It shows how global capital flows can shape domestic monetary policy and how central banks are increasingly forced to react to international developments. What is unfolding is not a sudden crisis, but a warning signal. It suggests that the era of effortless foreign absorption of U.S. debt may be fading. As that support becomes less reliable, the responsibility for maintaining stability shifts toward the central bank. This shift raises fundamental questions about sustainability. How long can the Fed serve as a backstop without altering the nature of the market itself? What happens if foreign demand continues to decline and intervention becomes routine rather than exceptional? These questions do not have immediate answers, but they define the path ahead. They explain why bond market dynamics deserve attention and why central bank actions are becoming more central to economic outcomes. Understanding this phase is essential because it reveals the mechanisms through which stability is preserved today and the risks that may emerge tomorrow. As the Federal Reserve increases its involvement in the Treasury market and foreign demand shows signs of strain, the effects begin to move outward into the real economy, where they become impossible to ignore. The first and most immediate impact appears in interest rates, which act as the transmission mechanism between financial markets and everyday economic activity. When Treasury yields rise due to reduced demand or increased issuance, borrowing becomes more expensive across the board. The U.S. government faces higher costs to service its debt, which places pressure on federal budgets and influences future spending decisions. Over time, rising interest expenses can crowd out investment in infrastructure, education, and social programs, reshaping fiscal priorities in ways that affect long-term growth. These higher yields do not remain confined to government balance sheets. They serve as the baseline for nearly all other interest rates in the economy. Mortgage rates, business loans, student loans, and consumer credit all move in relation to Treasury yields. As borrowing costs rise, businesses are forced to reassess expansion plans. Projects that once made sense become less attractive. Hiring slows, capital investment is delayed. For households, higher interest rates translate into more expensive mortgages, higher monthly payments, and reduced affordability in housing markets. This can cool demand, slow construction, and weaken one of the most important drivers of economic growth. Consumer spending also comes under pressure as credit becomes more costly and savings are redirected toward debt service. Currency markets respond as well. The U.S. dollar has long benefited from strong demand for treasuries, which reinforces its role as the world's primary reserve currency. When foreign demand weakens, even modestly, it can raise questions about the long-term strength of the dollar. A weaker dollar increases the cost of imports, contributing to inflationary pressures while also affecting global trade balances. For countries holding large dollar reserves, shifts in the dollar's value influence financial stability and policy decisions. These dynamics highlight how deeply intertwined debt markets and currency markets truly are. Internationally, investors and governments watch these developments with growing attention. Many countries rely on U.S. debt as a core component of their financial systems. When patterns of ownership begin to change, it forces reassessment. Some may diversify reserves, reducing exposure to a single market. Others may demand higher yields to compensate for perceived risk. These adjustments can increase volatility and make global markets more sensitive to shocks. At the same time, the growing role of central banks in stabilizing markets introduce these new challenges. Frequent intervention can blur the line between market forces and policy support, raising concerns about price discovery and long-term efficiency. Investors must decide whether bond prices reflect genuine supply and demand or are being shaped by central bank actions. This uncertainty can alter investment strategies and risk assessments. Politically, rising borrowing costs and increased central bank involvement become subjects of public debate. Questions about debt sustainability, fiscal responsibility, and monetary independence gain prominence. These debates can influence policy direction and international relationships, further complicating an already complex environment. What makes this moment particularly important is the gradual nature of the change. There is no single event that defines the shift. Instead, it is a slow evolution driven by necessity and adaptation. Japan's reduction in Treasury holdings and the Fed's increased involvement are part of this broader adjustment. They reflect a system responding to pressure rather than breaking under it. However, gradual change can be more consequential than sudden shocks because it reshapes expectations over time. As expectations change, behavior follows. Investors adjust portfolios. Governments reconsider strategies. Households make different financial decisions. These collective adjustments alter the trajectory of the economy. Understanding this process is essential because it explains why bond markets often send early signals of economic change. They reflect not just current conditions but beliefs about the future. As those beliefs evolve, the effects ripple outward, influencing growth, stability, and opportunity. This is why the current environment demands attention. It is not about predicting collapse. It is about recognizing transition. The actions being taken now are shaping the contours of the financial system that will define the next decade. As this story reaches its conclusion, the broader meaning of these developments comes into focus, revealing a financial system that is adapting rather than collapsing. Japan's decision to reduce its holdings of U.S. Treasury debt and the Federal Reserve's decision to step in as a stabilizing force are not signs of panic, but responses to shifting realities in a more complex global economy. For decades, the structure of global finance relied on a relatively simple dynamic. The United States issued debt, foreign governments absorbed large portions of it, and the Federal Reserve largely stayed in the background except during crises. That structure allowed borrowing costs to remain low, confidence to stay high, and the dollar to maintain its dominant position. What we are witnessing now is a gradual evolution away from that model. Foreign buyers like Japan are facing domestic pressures that require flexibility and reassessment. The Federal Reserve is increasingly tasked with maintaining order in markets that have grown larger, more interconnected, and more sensitive to shifts in confidence. This evolution does not mean the system is failing, but it does mean the margin for error is smaller. The bond market, long viewed as stable and predictable, is becoming a more active arena where policy decisions, global capital flows, and investor psychology interact more visibly. For households and businesses, the implications are tangible. Interest rates shape financial decisions, from buying a home to expanding a business. When borrowing costs rise, behavior changes. Spending slows, investment becomes more cautious, and economic momentum adjusts. These shifts may be gradual, but their cumulative impact can be significant. On a global level, changes in Treasury demand and central bank intervention influence currency values, trade relationships, and reserve strategies. The world may be moving toward a more diversified financial system where reliance on a single market or currency is reduced. Such a system can offer resilience, but it can also introduce volatility and uncertainty. Stability in this environment requires careful coordination and clear communication among major economic players. One of the most important lessons from this moment is the role of confidence. Financial systems function not just on numbers but on belief. Belief that debts will be honored, that markets will remain liquid, and that institutions will act responsibly when stress appears. Japan's actions and the Fed's response are part of maintaining that belief, even as conditions change. The Federal Reserve's willingness to step in demonstrates its commitment to stability, but it also underscores how much responsibility now rests on central banks to manage risks that once were shared more broadly. As this balance continues to shift, transparency and credibility become even more important. Markets will continue to watch not just what policymakers do, but why they do it. Understanding these dynamics helps explain why bond markets matter so deeply and why seemingly technical decisions can have far-reaching consequences. The quiet adjustments happening today will shape borrowing costs, investment behavior, and economic opportunity for years to come. This is not a story about sudden crisis, but about transition. It is about how a global financial system built on long-standing assumptions adapts when those assumptions are tested. The outcome will not be determined by any single decision, but by the collective response of governments, central banks, investors, and households. Staying informed and aware of these shifts provides a clearer view of the forces shaping the future of money, power, and economic stability.